And thank you for joining us for this Financial Poise webinar. I am Candace Klein. I'm a bankruptcy and restructuring attorney at Saul Ewing and a law professor at the University of Toledo College of Law. I look forward to being your moderator today. This episode is part 2 of a 4-part webinar series called MBA Bootcamp. We open the MBA Bootcamp with today's episode, How to Read a Balance Sheet and Why You Care. We have a PowerPoint deck, but don't expect us to go through it in order. We'll move around. We'll also, like other Financial Poise webinars, have a conversation. So don't worry if you're listening and not watching this webinar, you'll be just fine. The slides are not critical. They're here for your notes. When I am about to ask a panelist a question that I know relates to a slide, I will, however, call that slide out to your attention. Sometimes we will not rely on the slides at all, and you may, again, refer to them as your notes. On slide 7, we summarize this episode. On slide 8, we provide a description of the series, and we list the episodes on slide 9. And I call to your attention that we have 2 more episodes coming up: KPI, cash flow modeling and projections, and where did all my profits go? Mastering the concept of working capital. Our panelists are listed on slide 6. We have John Levitsky of HK Global, Jason Dinoff of KCP Advisory Group, and Ken Yeager of New Point Advisors. Like I said, I am your moderator, Candace Klein of Saul Ewing and the University of Toledo. We appreciate that you are not spending your time and money to hear infomercials. If you want to get to know us better, you may read more about us on slides 37 to 40. Financial Poise webinars are supported in part by sponsors. The sponsors for this webinar: the National Law Review on slide 3. It is a premier legal news website and trusted resource for attorneys, business leaders, and the general public. Also, Max Asset on slide 4. If you need to conduct an online auction, Max Asset offers a turnkey solution. This webinar is a production of Financial Poise. More about Financial Poise is available on slides 2 and 43. And before you do anything else, go to financialpoise.com now and subscribe to the free weekly newsletter. If you are attending the live premiere of this webinar, you can submit questions using your web portal. We may have an opportunity to address questions. If you are watching this on demand or have questions after the webinar, then you may see slide 35 for instructions on how to get an answer. On slide 35, as well as on slide 5, you will see a disclaimer. You should not go out and act on anything you hear or learn on this webinar. You are not our clients. We are not your lawyers or advisors. What we do here today is for your general education and not for you to act on without appropriate advice. What you learn is designed to help you communicate with your trusted professional advisors. It is not advice that is personal to you. All right, thanks for your patience. And without further ado, we will begin our conversation about how to read a balance sheet and why you should care. And we'll begin with a quick glance on slides 11 and 12, and they provide a simple introduction to the balance sheet. This is a key financial disclosure. Balance sheets are important to understanding any company, especially for startups. Throughout our conversation, we'll talk about that particular application in the startup scenario. Balance sheets tell us how much the company has in assets and liabilities or debts, and subtracting debts from assets, the net worth or shareholder equity in the company. If the shareholder's equity is negative, the company's debts exceed the value of its assets. If positive, the company is generating value for its investors. Of course, these are all oversimplifications, and we'll get more detail as we go along. The balance sheet is a snapshot at a point in time. It's issued on a quarterly and annual basis, and it does change over time. The balance sheet conveys a good deal of information to the educated reader, and a few examples are provided on slide 13. You might look at debt to equity ratios, changes in cash, and the nature of debts, receivables, and accounts payable, the nature of the company's assets generally. There are also off-balance sheet transactions that may help dress up a balance sheet. And on slide 14, there are a few examples. So now we're going to dive deep here on the balance sheet, and I'm going to turn first to John. The subject matter of today's webinar is the balance sheet, but there are other summary financial disclosures called the income statement and the cash flow statement, which we discussed a bit during our first episode of the MBA Bootcamp series. John, could you please describe briefly these three disclosures and how they differ from one another? For example, how the balance sheet is different from these other financial statements, and tell us who would want the balance sheet, what it's telling us and not telling us, and how that interacts with these other statements. And I just direct the viewers to slides 13 through 15. John, take it away.
Well, thank you, Candace. And welcome, everyone. A complete set of financial statements includes 4 financial statements plus the notes, the explanatory notes from management, and also a letter from, if they are audited, from the auditors, the independent accountant, or it may include a letter from whoever prepared them that provides some introductory information. Within those, there's the balance sheet, the income statement, the statement of cash flow, as Candace mentioned. There's also a fourth that's generally there, the statement of retained earnings or change of retained earnings. These 4 statements have a purpose. The balance sheet, as Candace said, is a snapshot as of one point in time. It summarizes the assets, the liabilities, and the owner's equity. So if you think about what is one of the fundamental accounting equations, it's assets equals liabilities plus owner's equity. It's measured as of one point in time, and it's measured as of the accounting conventions that are applied. For example, it may be United States generally accepted accounting principles. We'll call it GAAP, GAAP. How do we get from one period's balance sheet to the next period's balance sheet? Obviously, the business has all sorts of transactions, all sorts of flows. The accounting equation for the income statement is revenue minus expense equals net income. The income statement gets closed out at the end of each year. It's made up of what they call temporal, T-E-M-P-O-R-Y, accounts that only are open or active for that time period that they apply, and then they're closed at the end of the period to owner's equity or whatever the variation is for the particular structure of the company, such as it may be shareholders' equity if it's a corporation. So when that shareholders' equity entry is made to close out the net income to equity, that increases the equity on the balance sheet. That's how there's the link between the income statement and the balance sheet that gets reconciled at the end of each year. The cash flow statement does something similar to what the income statement does, but it's really a residual function of the income statement and the changes in the balance sheet. So how did we get from starting equity to ending equity? Equity, obviously, income adds to it. That's the way equity works. Distributions would be a reduction from it. So we know that owner's equity increases can come from positive income from the income statement. The statement of cash flow, though, is more informational. It's not a set of entries or special accounts that get closed out to the balance sheet. It doesn't have its own accounts, but it starts, if it's the indirect method, which is most usually done to prepare a statement of cash flow. They start with net income. They look at the changes in the balance sheet accounts over the year, and they make an adjustment also for adding back depreciation and amortization. The goal is to figure out how did they get from the cash in one balance sheet at the start of the period or the end of last period to the cash at the end of the current period. So it provides a reconciliation, but it also shows that items like increases in accounts receivable could be a short-term source of cash, but payments of dividends or payment of debt could be a reduction in cash, and it shows those types of flows. So you have two statements that are showing flows, and the fourth one I mentioned is a statement of changes in retained earnings. It shows how you get from essentially 1 year's owner's equity to the other. I mentioned there could be income, that's an addition. There could be dividends or distributions as a subtraction. There could be other items. There could be capital contributions. There could be capital raises and those sorts of things. So there is a difference, but a complete set includes all four of the statements that I just mentioned.
Okay, that's a wonderful introduction. And if we think about a hypothetical scenario where an investor, a prospective investor, wants to look at financial statements over time, maybe ask for 3 years of these financial statements so they see points in time and also an ability to calculate some reconciliations. Ken, could you tell us, if you're that prospective investor, give us some examples of what you're looking for and what is important for a prospective investor to understand about the balance sheet.
Yes. All right. So thank you, Candace. I'm going to layer on with where John was going and put a little bit different twist on it and kind of using. As an investor, I'm very interested in cash flow. So when you look at these balance sheets, to look at the cash flow and the risk of that cash flow. So both items, the risk of it and its potency. So in my three components that match up very much with the concept of cash flow and the way accountants talk about it and the way we should all think, I'm looking at first off what's current in my current assets, what we all refer to as working capital. Those can be slightly interchangeable. And this is my day-to-day operations of buying materials, paying for labor and overhead, and distributing goods and services, and then waiting to get paid. That's kind of the first element. What does that cycle look like? And we'll talk more about that as our hour goes on. The next group is long-term assets. Thinking of the investments in assets. What have I had to pay out for the infrastructure that supports all that working capital activity, which can be intense? I want to know what it takes to remain competitive. Can I buy or rent those assets, or do I have to make them myself? That costs money, and that can take a long time to recoup. So I'm very interested in those fixed assets that are kind of long-term assets. The next group is sort of the financing, the leverage, equity sort of side of the business. How does one pay for the working capital and the infrastructure? Do I have to borrow? How much can I borrow? And how much equity is expected to be deployed or remain deployed to be successful? Sort of a caveat that I have to think about, and John brought this up too in your opening remarks as well, is that a balance sheet is not a complete dressing of cash flow. There are things that are not on a cash flow, so it's not 100% of everything. And some really quick examples. If a company factors, the AR and related debt are off the balance sheet by GAAP rules. So I've got to consider what's going on with my assets as part of my current or working capital assets. If a trucking company leans into the common practice of operating leases for its business, those trucks and their debt will not be on my balance sheet. So I've got rent payments that are going through the income statement, but I don't see those assets that are being deployed. A really common one is to look at rental property. We don't even think about this much, but in our example that we're going to play with today, which is sort of a comic book store, it occupies a space, it rents long term. Those subsequent months of obligations are real that I have to pay in terms of rent, but they're not reported on the balance sheet. They just sort of show up as expenses.
Oh,
So those
that's
are some.
great. So we do have this concept of off-balance sheet liabilities, and that's clearly something to try to look at, right? And maybe you're getting that in some Q&A. So let's move to Jason and a hypothetical. And here's our hypo. It's pretty simple. I own a comic bookstore. I buy and sell old comic books. I pay rent. I don't have any employees. I have $57,000 in my checking account. I owe vendors about 10,000, and about 10 collectors and dealers owe me a total of about $100,000. So, what does that mean in terms of my balance sheet? What is it going to look like?
It's an oversimplified summary, but it's a good one because it does reinforce a lot of the points we've heard from the team. To some of the points you made a moment ago, just to add to them. When we talk about some of those off balance sheet liabilities, et cetera, John made a point to say when you get any kind of auditors or accountants report, there's going to be notes. Those notes are worth their weight in gold. The number of people who do not read those notes is ridiculous, but anything that should be a consideration will usually be found in those notes as a result of all of that accounting heavy lifting. To your point about the example of the comic book store, and I'm a big Marvel fan. So you've got a very simple sounding balance sheet. And I'm glad you put this slide back up because this is the crux of everything that has to do with the snapshot, as I think John called it earlier. It's a point in time. At any given time, this is going to tell you what you've got for assets, what you owe as far as liabilities or what you may owe, as well as what is the book value. And I know we'll talk more about what book value means, but essentially it's the accounting recordation of the equity component, whether it's partners capital, shareholder equity, etc. In our example, we said we have $57,000 in the checking account. Well, we may have $50,000 in the checking account, but the balance sheet may actually say less than that or more than that. Why? As a function of timing, again, the balance sheet is a snapshot, it's a point in time. We may say the checking account, that's cash, shows 57,000. However, if we have issued $20,000 to our employees for payroll, they may not have cleared that checking account. So in looking at our checking account balance, we may see 57,000, but the actual balance sheet on what's called accrual basis, where we're accounting for what we've already paid out, could show less than that. Assuming we don't have any payments outstanding, 57,000 would show up as a bank account balance. And under that example, we would have $10,000 of accounts payable, which is a liability account. So looking at our little math here, we would have 57,000 to the left in assets. So far, we would have 10,000 for vendors in accounts payable, which is a liability account. And then we said, I believe it was 100,000 across 10 customers. So we would have accounts receivable, probably just one accounts receivable account, also on the asset side, representing things of value to us. Now, by that math, I just said 57,000 plus 100,000, that's 157,000 of assets. But I've only said, $10,000 of liabilities. Right now, we're at a formula. If assets equals liabilities plus equity, then again, very, very simple math or caveman math, call it what you want. The delta between that, 157,000 less the 10, would equal 147,000 of net worth, capital, equity account, because a balance sheet is balanced. It's right in the name. Assets equals liabilities plus equity. Doesn't mean equity is going to be a positive number. It could be a deficit, which means what? It means that our debts exceed the value of our assets on book value, for example. Again, on book value, and we'll talk more about some of that off-balance sheet valuations, but it's an important place to look at because you're going to see other things in there. What we didn't account for here in your comic example, though, is inventory. If you purchase that inventory, you're carrying it at a value of asset. Eventually, you will sell it, and it will go through the income statement as a cost of goods sold. You'll have made some kind of margin, and that will flow through a small waterfall, again, to the equity count in net income. Again, profitability raising that equity account. But you would have an inventory account. If you own the shelving in the comic book store, you would have some furniture, fixtures, equipment. If you have a lease for some equipment that's in there. You might have a capitalized lease. You might have a uncapitalized lease or operating lease, so it wouldn't show up that way. You also may have a couple of amounts you owe some of your employees you haven't paid yet, or you could have a long-term loan that you borrowed money in order to finance your inventory. So there's a lot of things that may show up on that balance sheet.
That's great. So who wants to see this balance sheet? We talked about prospective investors. Who else might want to see this balance sheet?
As an owner, you want to see what this looks like and you want to use it as a measurement of your business itself. How am I doing? Do I have too much inventory relative to my sales? We'll talk more about how to do analysis of that information. It can tell you you're carrying too much inventory relative to the velocity of your sales. It could tell you that your debts exceed your assets, or that you've got a shrinking equity account, which would mean losses, or we're extending too much in debt. Other people who want to see this, though, it could be an investor we talked about. It could be your bank. If you have a very significant vendor who may require, in order to ensure that you're credit worthy because they're extending you terms, a significant creditor may want to see that balance sheet in order to test the healthiness of your business and whether or not they should consider giving you credit terms to support the company.
Okay, so I think it has a pretty important role in assessing the financial health of the company. So we have this general overview slide, the formula on slide 16. We also have within our slide deck a sample balance sheet, and that is on slide 28. And I'm going to pivot here and turn to Ken. We talked about inventory. Let's assume I actually track my inventory and I know everything I've paid for each newly published comic book. I also know what I pay for my rare comic books. I do this trade every week. Um, my question here, I also sometimes will even buy collections, right? Just flat, just give me the box, I'll give you a flat price, right? So my question is, how do I value these different types of assets? I have a couple different categories of comic books here. So now how do I value them? How do I keep track of them for purposes of these financial statements? And what else can you tell me what I should be doing?
All right, great. So, a couple of things. The first initiative is trying to dissect what it costs you to buy those assets. And let's say it's very easy. If I paid $1 for a magazine, I pretty much know I can put that on my books at the dollar that I purchased it for. And that's my all-in cost. It might be I included shipping costs in that or something to make sure, or I might expense that. But I've got $1. I say that's what it cost. Let's go to the next scenario, which is I bought a group of things. So now I have a collection, and I've paid $100 for that collection, and I've got 10 magazines in that particular collection. Not all of them are the same value, so I might want to decide that each one has a different value for purposes of my inventory. Because I felt like that if I bought that individually, I kind of know the price that I would have paid for it individually. So I'm going to kind of attribute or estimate some value. And this is sort of kind of where accounting gets into some of its more softer theories, where it's management's estimates as opposed to any sort of hard number. The other thing that can happen is I might be, as you said, I'm a trader of these magazines. And 2 weeks ago, I got my hands on a nice batch of Marvel comics, some of Jason's favorite stuff. And then a week later, someone else sold me another pool of these. And I happen to have in there Doctor Strange from the 1980s. And it turns out that when I try to do my allocations, I might have paid a different value. I paid $200 for the second set of 10. Do I have Doctor Strange at $10 per magazine, or do I have them at $20? And it turns out I might have them at both in my inventory. So it's kind of how I acquired them. Now, I might move forward through time and go talk to a banker or investors or have John doing a proper valuation of my business. And someone might say, these magazines, some of them have lost a little value, some of them have gained some value, and net, there might be some materiality here, which is something, another term that maybe John can help us with as we walk through today. But I might need to create a fair market value for that asset and change up my asset, and that might is then going to go through my income statement, and or might adjust my balance sheet in some fashion relative to my retained earnings, which is kind of where we put things that change on our asset classes when they're being marked up, marked down. It doesn't mean I have an event that actually occurred, or it may go that I actually went to sell the business, and therefore the next person who acquired those Doctor Strange magazines has a different value base for those magazines, and so they might change at that time. I think that sets up kind of the inventory enough. I don't know if John, you want to take that a little further, since I kind of tickled the valuation side of it.
Well, thank you. Under generally accepted accounting principles in the United States, what you were saying about the acquisition of the sort of portfolio or set when there's an acquisition made, that's usually a guide. And then under GAAP, in most cases, GAAP only allows gains on inventory to be recognized when they're actually realized, like there's a sale.
Mhm.
Usually have three broad categories of inventory methods, or four. You might have some kind of average cost. You might have first in, first out. You might have last in, first out, or you may have lower cost of market. But none of those is really a method where it allows a write-up. So if you're wondering from a valuation standpoint, where might the inventory value be closer to a semblance of market value? That's at the time where it's acquired, assuming that that's an open third-party market value transaction. But there, it's still only closer to the value for that purpose. That might be more like a wholesale value as opposed to a retail out the door to a consumer value. So the basic general principle on inventory is it's usually booked and carried at some type of cost. And then the longer the inventory sits, it raises issues about whether maybe some of it is obsolete or slow moving and should be written down. Or on the other hand, you're mentioning maybe you have some special collectibles that are unique that are appreciating. Maybe you have the Honus Wagner one-of-one baseball card from over 100 years ago that's is extremely valuable. But if you didn't pay a large current price for it, it's still going to be carried on your books at whatever the historical cost was when you acquired it, and you'd only realize that write-up when you actually realized the gain through a sale.
The overriding point being that we also amongst ourselves talk through is the balance sheet is not indicative of market valuation. That's not its intent. It certainly gives a lot of great information. And to John's point, there are transactions where you may be able to take what you paid for something and assign that value to those assets, but that's not necessarily indicative of their market value. It's indicative of their acquisition cost and how said cost was allocated.
Yeah. And
Yes,
Ken,
and so if I bought Ken's comic book store, and say I bought it, let's make up, I thought for $2 million. And I looked at all the assets except for the inventory and had confidence and had independent appraisals that all the other assets were worth $100,000. But I get an independent appraisal of the inventory at wholesale value and found it's worth $1 million instead of its carrying value, which is relatively small. From an acquisition accounting, I'm assuming it's Ken's Comic Books Incorporated, when I acquire all the assets of that company under GAAP, at that point, since I paid the $2 million, I usually have the purchase price allocation, and Jason can get into more detail on this. I'll put the $2 million purchase price on my books as the acquirer, and then I'll write up the specific categories of assets that can be specifically appraised. But then there's usually some intangible asset value that's over and above that. That may be goodwill, the excess of the purchase price over the identifiable specific assets, tangible and intangible, that I have values on. So as a buyer, I may have the $2 million price on my balance sheet for acquiring those assets as the value, and part of that may be acquired goodwill. So Jason may want to add some more refinements and detail on that.
That is a big function of that, and I'm actually dealing with that on a couple of matters right now. And that's this purchase price allocation and setting forth and assigning those values because you want them to be as realistic as practical. If you've got some control over that, you certainly want to be able to take advantage of it. In the case of my examples, we're trying to allocate as much as we can towards the depreciable assets because therefore we can get the tax benefit of write-downs over time versus goodwill or certain intellectual property and other intangibles where you may not have, specifically in goodwill, if you've paid too much premium over the value of those assets, you may not have the benefit of getting that write-down unless you take a future impairment over time. And we've talked through some great examples of that amongst ourselves. I believe, without pointing fingers at any bad decisions, I think the FedEx and Kinko's example came up amongst ourselves where FedEx paid an awful lot for Kinko's, but then wound up taking an impairment on that purchase because it just didn't have the value that they had acquired it for.
And I think that's a long way that we're saying is, although a balance sheet is a snapshot at a particular point in time, and it's based upon accounting conventions, most often a variation of historical cost, knowing more about the context and the timing and what the components are of what's in the balance sheet is very helpful to know.
Yes, it's a very fluid target over time. Relative to market, I think one of the things you'll read in balance sheets is they say the balance sheet as of, and it says it right here in our example, as of December 31, 2017. I like to inject the word for people who get a little lost in this, is that the balance sheet as was, it has moved on. Things have changed. We need to keep an eye on where we are in our current activity. And it was on that moment. Yes, that is a reasonable snapshot, but time has changed. And let's be realize that you may have new impairments or new value that's being created that you need to think about and tap in whatever situation you're in.
Okay, that's excellent. So the balance sheet, it provides us this information. We see it in the sample, but that's just an input. We still have to do a great deal of work to understand valuation and the business prospects, for example, of a target company or the company we own. So to help us do that, why don't we visit some ratios, how we could use some of this data for analytical purposes. And so, Jason, we talked about some ratios in episode 1 a few weeks ago. And now we have the balance sheet in front of us, and we could kind of get another level of detail under our belts. And I'm going to direct us to slides 29 through 34. And Jason, if you could tell us, how would we approach the analysis of the balance sheet and maybe give us one of our first important ratios?
Sure. There's a number of different ratios, and they classify a couple of different ways. We've got leverage ratios that measure and assess how we're doing with debt, the ability to meet our obligations. We've got not valuation, but we've got investment ratios, I would call them, that help to measure how much we've invested in the company and what has been the return on that investment as assessed by profitability. Amongst others, including both current and long-term types of ratios. The one up on our screen right now is called vertical analysis, and this goes back to the formula we had on from slide 16. Assets equals liabilities plus owner's equity, which we'll probably say a lot of times during this call, and that's important. And the reason why is assets equals liabilities plus equity. Your assets are the value, not a valuation, but are the value of what you have on hand at acquired value. So you've got your land, you've got your property, plant, and equipment, you've got your cash, you've got your accounts receivable. This is what your business has built. This is what your business has. Uh, the vertical analysis, which we're talking about here, is looking typically at the total assets. Again, the total sum of what the business has for value on its balance sheet, and whether it's liabilities or equity or any of those components, or even one of the asset items, it's looking to see how does that stack up? What is its proportion? If, for example, we had $1 million of assets and we had $100,000 of liabilities, then that would mean our liabilities are 10% of our assets. And that's good to know, because then that means from the formula, 90% of our assets is a net worth or equity category. These are different ways to measure and assess different things and different ways to take out of it. I don't use the vertical one as much, but certainly it does help you to compare over time how you're doing.
Mhm. Okay, and is there a thing called horizontal analysis, and what's involved there?
So vertical was looking at the different proportions to typically, again, assets. Sometimes it can be to debt, sometimes it can be to equity. The horizontal, though, is looking differently. Instead of going deeper into the balance sheet details, horizontal is looking across. So now we're talking multiple period of time typically, in order to understand how we're doing relative to how we did before. Again, the balance sheet is a snapshot, it's a point in time. So as Ken used earlier, this was December 31, 2017, but how was December 31, 2016, and how was December 31, 2018 in comparison to a base year, which shows either growth, improvement, too large an increase in assets, too large an increase in liabilities, or a myriad of those, to see how we've been doing and if what we're doing is adding incremental value.
All right, so there's a role for a financial analyst in this conversation, and we have another ratio to add to what we talked about in episode 1. And I'm going to give this to you, Jason, the quick ratio. So what is the quick ratio? It sounds so appealing. We can do it quickly. What is the quick ratio? And I note that on slide 31.
So this is and we haven't gone into overly much the differences in the classes of the balance sheet accounts, assets, liabilities, and equity. But assets, there are a couple of divisions. There's long term and there's short term, or as we call them, current and long term. There's also property, plant, equipment. There's different ways to kind of segregate the different classes. But when we talk about quick ratio, we're focusing on some pretty current stuff. We're looking at fast pace. We're trying to understand the things that turn into cash quickly. What does that look like to us? As opposed to equipment and land and buildings and converting those, we're looking at cash, we're looking at AR, and we're looking at those against the current liabilities, because that's giving us the understanding of how we can cover those current liabilities. Not stuff due over the next 10 years, not a mortgage, not a 7-year equipment loan. We've got accounts payable. We've got a 6-month loan. What is that? What is the amount that is owed on that? And how much do we have on hand in order to meet that obligation rapidly, without having to convert inventory into a sale, without having to sell big pieces of equipment? This is quick ratio, and quick means quick to cash.
Okay, quick to cash, and that sounds like the higher it is, the better it is.
100%.
So let's talk about another ratio, and here I'll pivot to Ken. Another ratio we hear a lot about, which is a current ratio, and that's on slide 32. How do you calculate it, and what is it good for?
Well, this is a very close to what Jason was talking about. We are still in the what he described perfectly as the current side of the balance sheet, the things, the working capital side. But it's another way to look at it. And all we're doing here is we're going from our very liquid assets of AR and AP, or accounts receivable and accounts payable, so assets and liabilities. We're also adding in inventory. And so one way to think about this is what I'm trying to do at the records at the I'm sorry at the magazine comic store. We are trying to figure out how to move that inventory, or how often is that inventory churning. I'm buying magazines and I talk about buying collections. I might have stuff that might stick around for a minute till I can find that perfect buyer. So my ratio starts to expand, slow down. Like you said earlier, a higher number is better. Higher number is better for current ratio, but I'm not going to see as high a number or turnover number with that. But I do expect one. But next door to the comic store is a deli. I've got fresh meats. I've got people who pay with credit cards. I don't have current accounts or trade accounts with vendors and customers. I'm going to see almost a daily turnover ratio of my current assets, where my cash is coming in because I don't have receivables, my inventory is moving because it'll spoil, and my vendors want to be paid in a very timely fashion. They're giving me days to pay that stuff off, and not weeks or months. Heck, some of them might not even extend me credit, and I've got to pay from the till to get my what I collected today is going to be what I'm going to be able to buy tomorrow to put on my shelf. So that's kind of a different ways that current ratio will impact a company. Red flag is a good way to also put this in here. I want my current ratio to be positive, and like we said, we would like to say a high number, so we have a lot of turn. When you can start to get into difficulties, that number will come down, and your current ratio might look like something like 1 to 1, which is say I've got just as much current assets as I've got current liabilities. That gets you into kind of a working capital challenge, and that will be a red flag that an owner should worry about. Management should be concerned, and certainly investors and lenders are going to raise an eyebrow and be ask you a lot of questions about how effective are we really being in our business. Are we really collecting on time? Is this inventory really necessary? Are we hanging on to things like the Doctor Strange magazine at $20 for too long?
Hmm. Interesting. Okay, so that gives us some guidance on our operations. And John, why don't you take us to another area of the balance sheet? And this is around debt and equity, and tell us how we calculate our debt to equity ratio and what that's good for. And I highlight slide 33.
Well, thank you. A little while ago, we said assets equals liabilities plus owner's equity is the basic accounting equation for balance sheet. So we put that in context. And if you assume that when you say debt, we're talking about total liabilities, then what the debt to equity ratio is looking at is what proportion of the total assets of the company that are reflected on the balance sheet at the accounting convention historical cost are effectively financed with debt, if we're defining that as total liabilities, compared to equity. It indicates in some way potential risk. A larger amount of debt is doing the financing than equity, if those are the proportions. On the other hand, we have to keep in mind that as the company grows and increases its profitability, if the debt is a relatively fixed or a diminishing amount that gets paid down, and if the company is successful in growing its earnings, then the accumulations of additional earnings will be recognized in owner's equity and will increase equity. And the proportion that's debt will either stay relatively fixed or decrease. So over a period of time, what it is, it's an effective leverage tool to try to leverage the benefits of earnings of a growing company. That said, we pointed out a little while ago that it's based on accounting historical cost convention, and that the amounts that we're talking about that are being used for equity, that's the book value of equity. That's not necessarily the market value of the equity of the company, which may be a lot different. It may be higher. But in these types of analysis, which is usually done for convenience, is it's done using the historical measures. Now, on the next slide, if I could ask you to flip to it, Candace, we have on the top of the next slide, the slide 34, three of the common ways to look at this type of ratio. If we look under solvency, where we see total debt to equity, that's where it's defined, as I mentioned a moment ago, as total liabilities divided by shareholders' equity. Total liabilities is all liabilities. That also includes accounts payable. However, there are other ways to look at this. Long-term debt to equity ratio, that would be looking at the interest-bearing debt only in that numerator and dividing it by shareholders' equity. The thinking here is that you may want to look at more narrowly, since there are other ratios like the current ratio that would be picking up the other categories of other categories of liabilities, that when we were looking at total liabilities and putting them into two categories. It depends on the purpose of what we're trying to measure. And you also could look at short-term debt to equity ratio. That would be the current portion of interest-bearing debt in the numerator, and get three different perspectives on this as to a perception that may be indicating risk, or a perception that may be indicating how well the company's able to leverage its financing. Keep in mind, to achieve an objective of stockholder wealth, which is a common goal for many owners and managers and directors of companies, they want to optimally use their assets, especially their financial resources. So something might seem like a measure of risk in one context, but perhaps in a different context and a different view, it may be indicating that together with other considerations and other ratios, maybe they are doing something that's optimizing their particular situation.
Okay. So looking at our, last, say 10 minutes or so together for this episode, why don't we break down the balance sheet into its three components? We've been talking about the formula that's on slide 16, assets equal liabilities plus equity. Ken, why don't you take us through the asset side of this formula? And here I want to zero in on slides 17 through 21. And in particular, I'm going to bring up slide 19. And if you could spend a couple minutes with us talking about assets and perhaps cash as well, relative to current assets.
All right. So this is backing into our working capital area. And this is why it's important. It explains to us how we're operating day to day in a business. So you've got to make your payroll. You're going to be paying attention to your working capital. You're going to have cash and cash equivalents. One of the interesting things about a balance sheet that says cash doesn't necessarily mean that there's actually cash sitting somewhere on a balance sheet or in a bank account somewhere that you could actually access. Some of the things that happen with cash is it can be restricted. Sometimes people will into us and say, here you go, but I need you to reserve some cash. You can be in control of it, or I'm going to put it in a special account somewhere else so no one can touch it. So it's not really cash as cash. There are some times when accountants also net liabilities against cash and to balance the balance sheet. And so you've got, I like to say that a balance sheet is a nice place to begin your analysis, but it is not the end place that you should go, because everything that John and Jason have pointed out, there are caveats to what you're seeing on the page. But this is the working capital place, and this is where we're trying to figure out if we're going to have, if we've got assets that we can use to, if you will, pay our bills. And those going down, obviously cash translates into something I can then fungibly transfer to a liability and pay it. I'm hoping that my accounts receivable will collect soon and become cash so that I can then convert it, pay my bills, pay my investors, something of that nature. And then I've got my inventory, which tends to be stickier, might last a little bit longer than my receivables. Might not in some circumstances, but mostly it does. And this is the stuff that I've invested in and I've put on a shelf somewhere and I'm trying to move it on. It's not cash. As a matter of fact, it's absorbed cash, but it's an asset. It's almost like I've traded my cash into inventory, but it's got value, so I get to keep it on my balance sheet and hopefully move it quickly. Hence the term current assets. current means different things to different people. Just we talked earlier about the deli. My current asset's going to spoil it within days, if not hours. A magazine, or in a comic strip or comic book situation, I might keep it for weeks or months before I want to turn it over. And then I might get into assets that literally in some industries might be considered a current if they're a year old. So time is a factor with current assets.
Mm-hmm. Okay, so Jason, why don't you then take us through the non-current assets and elaborate as to what those might be for a business? And I direct our attention to slide 20.
Absolutely. So the other part of the asset class, as Ken pointed out, this is what is not as liquid. This is the longer life, long-term, non-current assets. It's going to take longer. Traditionally, the expectation is that any value that you would recognize from these assets through a sale, liquidation, et cetera, they would take longer versus cash on hand, accounts receivable collections, or converting your inventory into a sale item. Again, those were all the current assets. So typically, we're talking property, plant, and equipment, but tangible assets, the machinery, the buildings, the real estate, the office equipment, and the intangible assets, which we've talked about, goodwill, patents, and copyrights. These tend to take a little longer. And that's one of the reasons why they get capitalized into the balance sheet. They have longer life to them. And in fact, because you're using that equipment over a period of time, you've got the concept of depreciation, and in the tangible and some of the intangible assets, I should say, you've got the concept of amortization, which allows you to reduce them over time and recognize a certain amount of write down during an operating period of whatever the life is deemed to be of those assets. Can be anywhere between 5 to 7 for pieces of equipment. If you've entered into a lease, for example, and you've done a number of improvements out of your pocket, you don't own an asset, it's a lease, but you just paid a fortune for what are called leasehold improvements. And so that winds up being this intangible asset that goes onto your balance sheet and does get amortized over time.
Okay. All right, so we have assets, so let's move to the next element in our formula, that's liabilities. And John, if you could take us through the liability side of the balance sheet, and I'll direct our attention to slides 22 through 25. And in particular, I'll rest here on slide 24, which details current liabilities. So could you talk to us about current liabilities?
Yes, these are the amounts that a company owes that generally come due within a year of the date of the balance sheet. And just like when Jason was talking about current assets, current liabilities are the mirror image counter concept, and they are ordered in the balance sheet in terms of which ones are due sooner and in descending order into which ones are due somewhat later. That's generally how they're looked at. Just like on assets, cash would be the most liquid, and then you'd have usually some sort of accounts receivable, and then inventory if it's a company like a comic book company. Here we have listed what the order may be for liabilities. Accounts payable, quite often they're due in 30 days. Wages may be due in 2 weeks or within a month, depending on how the wages are scheduled. Interest is probably due monthly if it's a regular monthly periodic loan. It may be due over a longer period. Maybe it's due quarterly or semi-annually or annually if it's some other type of loan. Warranty liability, that would be if there's some defect. Some of this is estimated, the warranty liability, and unearned revenues. They may have received prepayments. Maybe somebody prepaid for certain services or certain assets, but they haven't been earned yet because the services haven't been delivered yet, or the assets haven't changed title or being delivered in a sale. So the company may have already received cash payment for that, but they book a contra account called unearned revenues or deferred revenues to recognize that they really don't completely have clear reason to recognize profit on that transaction because they only have the cash side of it. The delivery hasn't occurred. So they recognize the unearned revenues. And then once the delivery of the service or the product actually occurs, they will undo this, they'll reverse this, and they'll recognize it as it falls through to profit.
Okay, so we have current liabilities on slide 24. I'll just note that we discussed very briefly in the slide deck non-current or long-term liabilities on slide 25. But now, why don't we get to the equity side, so the last component of our formula, and I'll move this along to Jason, where we're going to talk about the equity side of the balance sheet. That's slides 26 and 27. And here's my question. We've talked about the balance sheet as having values, but is not about valuation. It's not the value of the entity. So can you explain that to me? Because why doesn't the equity side, when I see owner's equity, why does that not tell me what my company is worth?
I'll definitely defer to John for anything he wants to add, but I'll take the first shot at that. So assets equals liabilities plus equity. This is a balanced equation. If you spend $1 and you bought an asset, your cash goes down, but your assets go up by $1. That's a balance. If you have an obligation of $1 and you have $1 of cash on hand and you pay that dollar down, your cash is down and that liability is down. The equity account on a balance sheet is made up of a couple of different items, one of which, of course, is the capital contribution. Owner puts money into the company or buys stock into a company or buys a bunch of assets and starts a company. There is some amount which is formulaic, that is not indicative of value. It's indicative of a purchase price paid or an investment put in. It's an exact amount. Again, not indicative of value. Over time, you may have losses, you may have profits. And as the income statement recognizes those amounts annually, their effect goes into the balance sheet in retained earnings, which is part of the equity account. So what's happening is you are accumulating or decreasing that equation, the equity side of that equation, based on activity, not based on value, not based on how much your business might be worth in the current marketplace, but truly based on those points. So it's a formula. The equity account on your balance sheet is a formula. It is a value that is calculated from contribution. It is calculated from the profits and losses of the business. Those are the primary drivers, any additional investment. But it is not going to be indicative of what the market would pay for your company, for example, or what it might be worth.
Okay, John, did you have any additional comments on the valuation point?
Well, value is not a one size fits all universal, easy to apply to any situation term. You need to understand what's the purpose, what's the date, what's the standard of value, what's the premise of value. I'm using some technical appraisal terms, but the reason there's more to it than just saying what's the value, you need to know what we're trying to achieve, what's the objective, and then we can measure it better. That said, the balance sheet, as we've talked about, recognizes items at historical cost to the extent they're required to be recognized. As we said, not everything's required to be recognized, and the timing when they're recognized makes a big difference. Second, for valuation, if we were just to stick with the balance sheet, in a simple world, how is a business appraisal done? It's done either on an income approach, so maybe the discounted cash flow of future expected benefits. It's also done on a market approach, a relative value, maybe using comparable companies to develop some valuation ratios, and apply to the earnings, perhaps the normalized earnings of the company. And the third way would be a reconstruction or cost approach, which might be to look at what's on the balance sheet and what should be on the balance sheet that's not, and what would it cost to reconstruct the current business. But none of those is based primarily on accounting conventions. Each of those requires valuation analysis to determine. And like I said, you need to know the purpose and the standard. For example, fire sale liquidation value would be far different in many cases than going concern long-term investor value. And then when you use the term value of the company, that's different, at least to an appraiser or financial analyst, than value of the equity. Many times the valuation methods I mentioned are used to come up with the overall value of the operating enterprise, and then perhaps subtract or make some allocation between debt and equity to get to the equity value. And then some of these companies have non-operating assets that are non-core to the business. Maybe they are in the business of shoe stores, and they happen to own a couple of franchise stores for fast food businesses that are not core. So there may be some non-operating assets here that would have to be considered as well. So the balance sheet is an important piece of information. It should be looked at in context together with other financial statements. And if you're looking really to do a valuation, it's a nice piece of information to have as an input and a consideration, but it's not the answer for business valuation.
Well, that's a wonderful summary. And I got to thank John, Ken, and Jason for sharing all of your insights today. And to our audience, thank you for your time and patience. We hope that you enjoyed today's webinar, which is episode 2 in a 4-part series in Financial Poise's MBA Bootcamp series. We thank you for listening, and we hope that you have a great day. So thank you.
Thank you for having us.
Thank you.
Thank you.